If we can have 10 million tonnes at 10% per annum lead, then we'll have blockbuster economics. And that was proven in the scoping study. So Toho's $90 million investment, they've already put $30 million in. The only condition for that is that we put in place the project financing debt.
Do you think that you could have done this better? Do you think that you went a bit early? Do you think you went too much with the money that you raised with Toho Zinc? Or is it a case of, I need to keep this thing on the road?
Hello and welcome to Crux Investor. First of all, thanks so much for watching this video. If you like it, give us a thumbs up and please leave your comments below. It just helps us to try and understand what you're thinking about, what concerns you, what questions you'd like us to ask, and sort of general mood about different commodities in the marketplace. So please make an effort to do that. And if you haven't already done so, another plead from me, please click the button in the corner of the screen to subscribe to our YouTube channel. And if you want to see more videos like this, you can always click the notification bell. We talked today to Alex Molyneux, the CEO of Galena Mining. They're an Australian listed developer. They're focused on lead with a small silver byproduct. We get into the business model and what Alex has been trying to achieve. They're reasonably advanced, well-funded project, and Alex talks us through the thought process that they went through to be able to get this funded. They are going to be looking at debt. Obviously, current situations may be restricting some of that activity at the moment, but interesting project, quite like Alex. Obviously knows what he's doing. I think that you may find this quite interesting. Take a look in the description below. It kind of describes some of the topics we discuss. Anything that interests you in particular, you can click on that timestamp and that'll take you to that part of the video. So enjoy what Alex had to say. Good afternoon, Alex. How are you, sir?
Good, thanks, Matt. Thanks for having me on.
Yeah, no worries. So where in the world are you?
I'm in Taipei City in Taiwan right now. So this is where I'm passing the coronavirus lockdown, I guess.
Fantastic. And what's it like over there? Is it sort of, is everyone, following the rules?
Well, it's actually probably the best country to be in because there's no community-based infection. They reacted very, very early, so there's no lockdown. I went out for lunch today. I'm going out for dinner, so it's just it's managed it extremely well.
Oh, mate. Well, I guess you guys have had SARS and
yes,
incidents before, so there was protocol which I guess kind of snapped into action pretty sharpish. Well, that's great news. Well, I'm glad you're going to be able to enjoy dinner out tonight. I'll be eating in. So thanks for reminding me. Right, Alex. You're a fairly prolific guy, well known in the industry, so I do appreciate you coming on. Today you're going to talk to us about Galena Mining, lead, zinc. So why don't you kick off, give us that 1 minute overview and we'll take it from there.
So Galena is a relatively unknown company. It was came to market through IPO on the ASX in September 2019 following the acquisition of the Abra lead silver deposit in the Gascoyne region of Western Australia. So we have some exploration permits, but our core focus is that Abra lead zinc project. The company's got a 70 million Australian dollar market cap today, no debt, and that project has really been through the study phase and is moving towards the full construction phase as we are now.
Yeah, I mean, it looks like there's a lot going on, but before we kind of get into that, can you give me a sense of, how did you get involved and what it was that you set out to try to build? What's the business plan, basically, from day one? And has that changed?
Yeah, so I got involved after I had announced that I was going to finish up at Paladin following the restructure of Paladin. There was actually quite a long period. I think there was like a 6-month period that where I'd announced the departure, but it was ongoing, and a few people made approaches to me, including the founding shareholders and a couple of directors of Galena, and it was an interesting experience because the company had just put out a scoping study, and these guys came to me and said, there's a base metals project in Western Australia with these kind of investment returns and very low technical risk. And I sort of said, well, hang on a minute, I'm really focused on the mining industry. If there was something this good, I would have heard about it. And I just didn't, the company was new and I had, so, they asked me, they sort of said, listen, we're pretty sure this is going to go into the next phase in terms of a much higher phase of study level, and, go through the permitting phase and the financing phase. And, we'd really like to know if you're interested to be involved. And, I did some due diligence and everything excited me. And I ended up agreeing to join in the middle of 2019.
Okay, so relatively new. So what was the plan that you bought into? Because I'm always interested in saying, what did the company set out to do? What did they think they had? And how things evolve and change? Because mining's tough, markets are tough. How do you kind of keep the show on the road?
Well, this deposit, by the way, Abra, is not new. I mean, it was discovered in the early 80s, so it's been around for a long time. These guys had a geological contention. So Abra previously had never been brought into a mine because it was considered a very large but low-grade lead deposit. So there's historical resources like 90, 100 million tonnes at 2, 3, 4% lead. And so it just never stacked up in an economic sense. And so the team here had initially focused on a geological contention, which was the old idea was if you tried to increase the cutoff grade, it wasn't proven that there would be a contiguous ore body at a higher grade that had that would have good economics for mining. So that was the contention that these guys had in a geological sense. And they were at the stage where they were proving that contention with drilling. So when I joined, there was a large drilling campaign had just been undertaken, and they were exactly right. So they were effectively infill drilling an area of the deposit, and they were getting very good grades and thicknesses, and they were able to come up with a resource that had a much higher grade mine plan. So at the time, the concept was, when I joined, it was if we can have 10 million tonnes at 10% per annum lead, then we'll have blockbuster economics. And that was proven in the scoping study. So, but I guess at the time I was joining, and I joined shortly after another gentleman by the name of Troy Flannery, who was at the time joined as Chief Operating Officer, very experienced mining engineer and very experienced as well with studies and analysis of pre-development type projects. And so we had this idea that 10 by 10 is great, but to have a project that's genuinely attractive in the financial, to financiers and to maximise the value, we want to look at a project with a bit longer mine life and whatnot. So we actually ended up almost dialing back the cutoff grade a little bit from the scoping study, and we put out a PFS with a 14-year mine life and an average grade of about 8.5% lead, and it had stellar economics.
Yeah, see this is the bit that really kind of gets me excited here. Is like if I look at your share performance last while, ended 2018 pretty much where you are today. So you had a really good year last year. Was that off the back of people getting excited about silver again, or why do you think last year was so good?
No, I mean, silver for us, depending on your silver price scenario or whatnot, it's less than 10% of the revenue in the project. So silver's very nice to have as a balance in the project, but it's not, people aren't buying our stock for silver exposure.
So what did people see? What did people see?
So I think the real step change that happened for our business last year was the investment by Toho Zinc of Japan. So up until the Toho investment, we were just another junior. But before Toho invested, the market cap was about $30 million. And, we're talking about projects with $160, $170 million worth of CAPEX spent. And everyone sits there and says, I like the project, but the risk of how you're going to finance it is why I can't buy the stock. So Toho, we ran a process in late 2018 to see we approached everybody. We had 15 different people in a data room. We were talking to people about, PE style investments, all kinds of different things. And Toho emerged from that process as a customer, saying we would like to invest. We ended up doing a deal with them to invest 90 million Australian dollars for a 40% stake in the project. So it valued the project very highly, and it also gave us the equity that we need to build the thing.
Right, and so we're going to bounce around here because there's quite a few moving parts that you've managed to put together.
Yeah.
But let's start with the first thing. So what were you brought in to do? So if they knew what they knew about the project, were you brought in to be able to introduce finance?
That's my, I guess, main sweet spot. But it's not just about, my role's not to just sort of come in and go pick the pieces up and say, great, I have a lot of connections in the industry. I think I know who might be interested to finance this. It's also about making sure that you're involved in the technical preparation and, in fact, the project design phase to be able to create a project that is going to be supported by the financing market. So I think a lot of people don't understand that. And, in fact, it's tempting for people in the industry to say, okay, I'm going to design the project to maximize theoretical NPV. But what they don't understand is your cost of capital is actually variable, right? And it depends on whether the project is going to appeal to debt financiers or be solely equity finance or whatnot. So you have to have this mindset coming into the project design phase. So I think, I guess my skill set as applies to Galena is not just about connecting the company with finance. It's also about creating a project in its design sense and also in the quality of the data. I mean, there's a quality of work you have to get to that that you can have people come through a due diligence process and make, executable offers in the end. And that's another thing where I think a lot of projects miss out because companies are starved of capital, so they cut corners on the work and then they fail to get additional capital.
So this is a really interesting conversation. I come from the finance side. Okay, I would be looking at companies and trying to work out what I did and didn't like. Green flags and red lights. But there's a little bit of what you're saying there that says to me, actually, the money drives the way that you design the project. So, a lot of miners do it, as you said, here's the way we do it. We'll work out what we've got theoretically and now who wants it. And you're saying, well, actually, we've got to follow the money, understand what they want, or the best way that Alex can, present this information to be able to extract that money from the different types of money sources out there. So you've got to have an idea in your head, don't you, before you start what you think you need to build. And do you do that from having had conversations or just experience as to what you think will get over the line?
Well, so the first thing I'd say is, so it's not the driver. Okay. You've got, your technical framework is still driving the bulk of what you're moving forward to, but it's a constituency in terms of that you have to understand when you are making decisions in the in the pre-development and study phase. So I'm not saying it's the key driver, but it's a constituency, and it's a constituency I think that's often ignored. So, that is a point here where now in terms of is it experience, it's a mixture of I have a lot of experience financing projects, so I've had let's say trial and error type experience, and I know what works and what doesn't work with different groups of financiers and whatnot. So that's part of it, but also, as you say, it's also an ongoing process of like the first thing we did after the PFS, as I said, was we ran this active process. Now, we picked an equity partner from that process, but we also had other parties in that could be providers of debt in the next stage and whatnot. And we were getting early feedback from those parties as to what their sweet spots were with respect to this project and what we had to do to move it to the next level for them.
Right. Okay. So, and as a result, you've got a lot of cash in the bank at the moment. So you've got some options. Can you talk to me about the economics of and we will talk about the assets and the projects themselves, but I want to talk about the money side of things first. So you've got some cash in the bank. Roughly, what is it these days?
Well, as at December 31, it's 27.5 million Australian dollars and no debt.
Right, and you're burning on a monthly basis roughly what?
Well, right now we're doing a series of discrete tasks basically to de-risk the first phase of the project. So it's all of the site preparation. We're also mining the box cut and whatnot. So there's a spend going on that's not an ongoing spend, put it that way. So the ongoing spend, the burn, if you like, other than those discrete tasks, is about 400 grand a month. But we're spending about $10 million at the moment on a series of tasks that'll be complete around May.
Okay, so that gives us a sense of how much cash there is and what the runway looks like, which is great. So between now and that point, you've got a number of other deliverables. Looking at your PowerPoint, you've done a lot of the work here. What more have you got to do before you can get into production?
Yeah, the project, you could say, is approximately 10% complete as we stand here today. Almost 10% complete. It's probably around 9%. Now that means we have so what we have now really is a site that's ready for an EPC contractor to be able to mobilise to, and an underground mining contractor to be able to mobilise to. Other than some other infrastructure like construction of the tailings storage facility, those are the main tasks that drive to production of first concentrate. Now, we've awarded the EPC contract, so we know who that's going to be. That's going to be GR Engineering Services. There is a price for that, 74 million Australian dollars. The legal terms and whatnot are all sorted out. And that contract is waiting there for us to start the procurement and construction phase. The underground mining contract, we have selected a preferred tenderer, and we're very close to being able to actually enter into that contract. So what's missing here is the debt financing piece. So we'll be running a debt financing process, and we need to close that. And literally the day we close that, the EPC and the mining contract sort of swing in, everything else ready to go. It's all permitted. It's so those two contracts start to perform, and then what your timeline is to produce first concentrate.
Okay. What's the price of lead per pound these days?
In a per pound sense, it's 70 cents US per pound.
Right. Okay. And what's that doing to the economics of your project at the moment?
So it's when we look at the economics of the project, what's been great about this coronavirus period is the economics have been quite robust through it. So we did the DFS in July of 2019 using a 92 US cent lead price, and the Australian dollar was 70 cents at the time. So that comes out to $1.30 Australian, right? Now, today's lead price in Australian dollar terms is $1.26. So, your revenue is about 3% lower. By the way, we bought back a 1.125% royalty in that intervening time as well. And also, most of the CAPEX is denominated in $A terms as well. So if you kind of get your mind around this US dollar denominated revenue. So when we look at the economics for the project, it's not it's not materially adverse. The cash flow margin is reduced from 48% to 41%. So extremely robust cash flows.
Right, and so that doesn't affect any of the terms of the Toho Zinc agreement, does it?
No, so they have, so Toho's $90 million investment, they've already put $30 million in. They have a $60 million tranche to go, and the only condition for that is that we put in place the project financing debt.
Okay, so it's not conditional on price in the market or effects of anything else that may be affecting the company at the moment. Okay, and what's the timing on that?
On the debt?
Yeah.
That's the open question at the moment. That's the key thing that sort of keeps me awake at night, if anything does. We've run this debt process that's taken a little bit of time. One of the things that's taken some time on the debt process is when we did our DFS, we were still doing a very active drilling campaign at that time. We had another 18,000 metres of drilling happening at the time. And the drilling was complete subsequent to the DFS, so we updated the models and the whole thing. So the main swing of the bank financing process didn't really take place until late 2019. And then going through that whole process and whatnot has put us into a position where it's a little bit, it's starting to slow down because of coronavirus issues. There's a mix of things in that the banks are moving slowly right now. They've slowed down quite a bit. I think primarily because of market volatility, and they're just waiting for that to settle down. I think in general that the debt providers are pretty comfortable with the way, as we've talked about before, the project cash flows have been robust through this crisis. But the banks seem to have their own issues and distractions, and the kind of teams that you're dealing with, for example, are dealing with other clients who have got issues with their covenants or there's timely issues that I have to deal with. That's one thing. There's other issues associated with simple logistics, like if bank expert X or Y needs to come and see something on site and is based in New South Wales, we can't get them to Western Australia right now. So but from our perspective, we have everything ready to go. We continue to have engagement from the banks and non-bank debt providers, by the way. So we know that's hanging out there, and we just have to kind of we've got a funding situation that doesn't cause any issues for us. So we've got some time here. So we just have to take our just take what's happening, and I think that we're in very, very good shape to just wait until things calm down and close the financing.
Okay, so just coming back to the point you made earlier with regards to structuring or changing things around from the mining perspective, to be able to have better conversations with, like, say, debt providers or other finance as well. Do you think that things like, extending the life of mine. Okay, I totally get that. That would tick one of my boxes. But given the cautious nature of debt finance, it's always the longest pole in the tent when you're trying to get it done, because they're a little bit more cautious and they need to work out how they perfect security and a long list of things that they need. Do you think that you could have done this better? Do you think that you went a bit early? Do you think you went too much with the money that you raised with Toho Zinc? Or is it a case of, I need to keep this thing on the road, and I've done a pretty good deal? I hear you bought your royalty back. So you're thinking about these things, but talk me through the thought process as you went through there to be able to negotiate a better deal when it comes to the debt.
Well, firstly, I think that the Toho deal created a lot of value for us. So not only were they was the valuation a very high premium in comparison to the market value at the time. But the way it works with the 30 million of tranches we had up front enabled us to undertake works on the project that significantly de-risked it. That massive drilling program that we were doing that I was telling you about that was happening it was completed after the DFS, that cost in the region of $5 million, right? So, that came from Toho's money. Being able to de-risk the site by doing all these site works is very, very important. We've been able to, one of the areas where people often slip up is on having a site that your plant EPC contractor can mobilise to without risk, because if they're delayed in mobilising, that's a cost that starts to get out of control pretty quickly, and it's not something you have recourse back to the EPC contractor on, because in a way it's your fault. So you either add these works into the EPC contract and then pay the EPC margin on top of them, and they cost a lot more, or you take the risk yourself. So by doing those works now, we've been able to do them ourselves, but without the pressure of potentially tripping up and causing wider issues with the project. Now, in terms of the funding, when I look at my cash burn, other than those discrete items, so we've not committed to anything that's beyond those specific discrete items. So, if I can sit here for another 2 years, if that's how long it takes me to get the debt. Now, that's not my belief, by the way. I think what I know from the process we've run is that debt is available for this project, and we're very close to getting it, and we just need the market to calm down a bit. But we're not in a situation where we have any kind of where we've bitten off more than we can chew in a financing sense. That's one thing I think that one of our philosophies as Galena is to be pretty careful with this stuff. So I think that's our point here is we raised a big chunk of money first, and then spent a prudent amount of that de-risking the project and locking away the cost of those items, right? So I know that there's not going to be a cost blowout on a chunk of my construction items because I've already done it. So, those things I think have been really good use of that money, and we're sitting in a good position now.
Yeah, I think I would agree with that. Like, I don't necessarily think there's a right or a wrong answer, but some companies want to get the cash up front, give them the ability to kind of get on with it, take the cash when you can, is a well-trodden phrase in banking. Yep. It certainly was when I was banking. And others believe that they'll just raise small amounts of money. They don't want to have the appearance of diluting shareholder value. But at the same time, they're losing the opportunity to create shareholder value. So it's an interesting debate and a conundrum, and I wouldn't be a CEO of a mining company for love nor money. But what's your kind of share register look like in terms of retail, institutional, insiders, management, etc.?
So our largest shareholder, our largest shareholding is 19.6% of the company, which is beneficially owned by a gentleman by the name of Tim Roberts. He's a sort of a high net worth, very well known sort of brand name investor in Australia, and has came in through a placement and has made additional purchases of shares in the secondary market subsequently. So he's our largest shareholder. Board and management combined have 25%, or just under 25%. And then I'd say the institutional, sometimes it's a bit hard to see your institutional shareholding because of nominee holdings and things like that. But based on a look through, the institutional shareholding is probably around an additional 20-25%, and then the rest is retail. So we actually, we're very light retail investment. That we only, in total, we have around 900 shareholders. And I think one of the main issues for us is that because people like Sandfire Resources with their DeGrussa mine, or Cirrus with back in the day with their Nova Bollinger mine, which are very similar mines to ours, base metals with similar economic returns. They've been public for a lot longer, sort of went through the exploration discovery phase as a public company, so generated a lot of excitement. They had sort of thousands of shareholders at the point at which they were coming into construction. So we probably, I still find that not that many people are aware of the company. So you know, I think we'd like to build up more of a following. We're not unhappy because we've been able to get our funding and keep moving, and we think life will take care of itself eventually. But I do think it's, in a way, it's a missed opportunity for some if they can't participate. But
no, I'd agree with that, because I wasn't sure when we were doing the research whether this was meant to be an institutional story, because there are obviously some big names in there on the register that we found.
Yep.
Not a lot of chat about you guys from the retail, and you know, possibly for the reasons you've just outlined. But your hope, or you aspire to maybe to bring more retail into the following.
Well, you know, the one thing I think is there's a symbiotic relationship between retail and institutions. Our company is well liked by institutions, and we have quite a good representation in terms of the number of good quality institutions we have on the register. But when I look at their ownership positions, they actually sort of own a little bit less than they might otherwise be able to own. And the biggest issue they have is liquidity, right? So if we can build liquidity in the stock, then the instos will buy more. So that I know from my discussions and with the insto holders here. So that's why I think for us, and I think retail investors also should understand their role in that too. It's really important. We want retail investors involved. They're as important to us as large institutional investors because of the way the interaction in the market.
Okay. No, I absolutely agree with that 100%. I think it's the downfall of a lot of companies, especially when they've got one or a couple of big shareholders. The liquidity just isn't there, no matter what you do.
Yep.
Can you do me a favour? Lead, not really that loved. It's a kind of unknown. It's not that sexy. No reflection.
Yeah.
But could you give us a little bit of a background of the lead market in terms of where it is today and maybe futures? I know it's another commodity that's putting up its battery revolution credentials. So give us your view.
Yeah, I mean, lead's a battery metal. It's an LME screen traded base metal, so it's a liquid investable metal in that regard. It's probably had one of a liquid market for almost a longer period than most metals. It's been used in all kinds of applications for more than 100 years. Its main use today is as a battery metal, and primarily in lead acid batteries. So when we look at the lead acid battery market, roughly 85% of lead's use is going into automotive, and then the rest of it is into stationary applications or small. So just dealing with the smaller market stationary applications, that's actually growing very well right now. But it's things like, for example, mobile phone towers use lead acid battery to make sure that their power supply is going to be uninterrupted and whatnot. So things like 5G rollout will have a high demand for lead because of the higher power usage of a 5G tower versus a 4G. But coming back to that main use of automotive, when we look at that automotive market, we say 85% of lead is automotive. The numbers vary from time to time, but roughly half of that is people replacing the lead acid batteries in their cars, and or just over half, and just under half is the original equipment market, i.e. new cars, right? Now, lead, by the way, as a battery metal, differentiates itself from something like lithium, for example, in this key way. Lead battery per unit of charge is about 4 times heavier than a lithium ion battery, but it's 1/10 the price. Okay, so when we look at the future here, the biggest question I get about lead is, well, hang on a minute, like, what about electric cars? Well, the lead acid battery is not going to be the propulsion battery, because if you want a 50 kilowatt to 100 kilowatt battery, it'd just be too heavy. The performance of the car wouldn't meet the consumer's requirements. But every electric car still has a lead acid battery, right? So in your internal combustion engine car, that lead acid battery is running the safety systems. Particularly, a lot of cars have electric braking, for example, your hazard lights, your headlights, your windscreen wipers, and it's also running the ignition of the engine, right? Now, all of those backup features are still required in an electric car for the same reason that if you run out of petrol coming down the hill and you want to be able to apply the brakes and switch the hazard lights on, that's the same case if you run out of power in your lithium-ion battery. Now, what it doesn't have is the ignition function. It doesn't have that in the electric car, but it takes on a new function, which is that in general the battery management computer is running on the lead acid battery. Now, the battery management computer, but when you switch off an electric car, it doesn't switch off like an internal combustion engine car. This computer system's running the whole time and monitoring the state of the lithium-ion battery, and also when you're charging it and whatnot. Now, it's making sure that it's monitoring things for like, if the lithium-ion battery is overheating and things like that, and it's managing those issues. Now, it has to have a cycle time that's different to the lithium-ion battery, and it has to have a wider operating range, right? So if you're in Mongolia and it's minus 60 degrees and your lithium-ion battery is just sort of ceased to be responsive, then your lead acid battery is still going to be there going, yep, okay, everything's okay, right? Now, so in a electric car, the lead acid battery is roughly 10% smaller. So there is a little bit less lead that's being used, but it's there. Open the frunk of a Tesla, you'll see one, and it's in every electric model. So it's not being replaced. Now, when we look forward, though, what I will say about lead is it's different to the stories of lithium and all these others. We're not talking about a growth story. We don't sit out there and talk about a massive growth story. The lead market is growing at about 2% per year. So, if you ask Wood Mackenzie, the primary expert on the market, they got that kind of forecast going forward till 2035. They're taking into account the transition to electric cars. They're taking into account things like 5G, mobile towers and stationary uses. What the thing with lead is, there's not a great availability of supply, and most lead is produced as a byproduct to zinc. And the zinc industry, the lead byproduct grade has just been declining over the last few years. And when you look at the inventory of new projects for zinc, on average, it has a lower lead byproduct grade than history, right? So you're just seeing that there's just less, primary production of lead is being driven by people's interest to bring on production of zinc, but there's just less and less of that lead going forward. There's another thing going on in the market that suits us specifically, which is a lot of the new sources of lead are dirtier. So they've got issues with things like arsenic or cadmium in their concentrates, whereas we've got a very clean concentrate. So there's a definite room in the market for our concentrate.
Fantastic. Look, Alex, I appreciate you running through that, and I wanted to speak to you to get to know you, and get a sense of what you're about. But and I do thank you for running through how you've gone about understanding the economics and the financing as well. So, but maybe it'd be great to have you on if you be kind enough to come back on and tell us a little bit more about the project and get into the detail of that. I'm not sure we've got time to do that today, but so like I say, thanks very much, and enjoy your dinner tonight, and we'll speak to you soon.
Okay, I appreciate it, Matt. Thanks very much.
Okay.
I appreciate it. Thanks for the time.